Good day and welcome to Dr. Lal Pathlabs Q4FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Siddharth Rangnekar of CDR India. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone, and welcome to Dr. Lal Pathlabs Q4 and FY23 earnings conference call. Today, we are joined by senior members of the management team, including Honorary Brigadier Dr. Arvind Lal, Executive Chairman, Dr. Om Prakash Manchanda, Managing Director, Mr. Bharat Uppiliappan, CEO, Mr. Ved Prakash Goyal, Group CFO, and Mr. Shankar Banerjee, CEO of Suburban and other group companies. I would like to point out our standard disclaimer here. Some of the statements made on today's call could be forward-looking in nature, and actual results could vary from these forward-looking statements. A detailed disclosure in this regard is available in the results presentation, which is available on the stock exchange websites. I would now like to invite Dr. Lal to share his perspectives. Thank you, and over to you, sir.
Thank you, Siddharth. A very good evening and a warm welcome to everyone present on this call. We are here to discuss Dr. Lal Pathlabs Q4 FY23 earnings, and I would like to take you all through the key developments and updates during the period under review. India requires quality diagnostics of scale. Over the years, we have tracked the gradual evolution of the way doctors and patients manage disease and health. Accurate diagnostics is increasingly contributing throughout the treatment process, including health management, disease detection, prognosis, diagnosis, treatment planning, and post-treatment monitoring. We therefore continue to invest in creating an efficient, technology-backed network that can align with the growth in sample volumes. To start with, I am delighted to share that Dr. Lal Pathlabs has stocked 15.5% growth in the non-COVID revenue in FY23. We have proudly served about 27 million patients in FY23. This has come on the back of a sharp focus on core operations across the country, including Tier 2 and Tier 3 cities, and investments in digital infrastructure. We have continued to make progress across our 3 strategic pillars, that is geographical expansion, creating a unique and specialized portfolio, and augmenting the technology infrastructure for the future. The highlight was the unveiling of our Mumbai reference lab at Vidyanagar in January this year. This has immediately resulted in the increased testing of the high-end tests, and it is also the first private lab in West India to have a BSL Level 3 biocontainment lab. This speaks leaps and bounds of our commitment to offer best-in-class services to our patients by bringing accurate diagnosis at reasonable prices to the fore. We also added a second electron microscope at our national reference lab in Rohini in Delhi. At this point, I would like to remind you that Dr. Lal Pathlabs already has the world's largest histopathology testing center, or LODE, processing up to 1,400 biopsies a day, and also the largest kidney biopsy testing center. We were the first private lab in South Asia and Southeast Asia to have an electron microscope way back in 2016. Furthermore, I am pleased to share that we continue to work towards enhancing our technological capabilities. We have begun implementing an upgraded lab information system and advanced tools like artificial intelligence and data mining. These have enabled us to achieve enhanced operational efficiencies and quicker turnaround times, or TAT. We continue to add new tests to our test menu and diversify our reach to a higher franchise share of patient service centers. Our processes are tuned to drive trust towards our brand, and therefore I think we are uniquely placed to both drive and benefit from the expansion in consumption of diagnostic services going forward. Thank you very much, and I would now like to hand over the floor to Dr. Om. Over to you, Dr. Om.
Thank you, Dr. Lal. Welcome everyone to Dr. Lal Pathlabs Q4 and FY23 earnings call. I hope that you and your loved ones are keeping safe and healthy. I'll share a few of the industry and business insights that I see emerging based on FY23 results. During the entire FY23 in quarterly commentaries, I've always been highlighting that we should analyze annualized instead of quarterly trends. Now, since the financial year is over, the entire analysis becomes a bit more meaningful as we have full year numbers in front of us. Let's have a quick look at FY23. While FY22 was operationally very challenging due to very high incidence of Delta and subsequent overhang of travel-related test requirements and various waves like Omicron, etc. In contrast to FY22, we experienced FY23 turned out to be financially very challenging for the entire industry due to the following reasons. Number one, nearly 80 to 90% decline in COVID and COVID-related revenues. The higher the contribution of COVID testing to the total revenue, bigger the challenge. The second is inability to roll back capacities and manpower and reagent stocks due to unpredictability of the future COVID demand pattern. On the other hand, FY23 also experienced uneven quarterly base and coupled with aggressive competitive activities further made it difficult for all of us in understanding the underlying growth trends. Now, since FY23 is over, I am clearly seeing few trends. So my take is the following. Number one, bundled packages have become way of life in our industry. Contribution of Swasthfit to LPL total revenue has further gone up to 22% in Q4. This means we are doing higher number of tests per patients, and that's very clearly visible in our sample volumes as well. Number two, CAGR trends based on, this is our internal estimates of few large players, their data is in public domain, that also include their inorganic assets and residual FY23 COVID revenues. Over 4 years suggest that some of these players have experienced all put together about growth rate of 10 to 11%. Now, this may not be reflective of entire industry growth, but if I look at all the data put together of in public domain, I am seeing CAGR of 10 to 11%. Number three, after a long gap, we saw in Q4 some of the players have taken price increase, and we also did a little bit in the month of February. We will talk about that. Number four, as the pressure on margins build up in the industry, especially on smaller and mid-sized players, we do see consolidation opportunities emerging in times to come. However, valuation expectations and unavailability of quality assets will make this journey a little difficult. On Suburban Diagnostics, as a platform, we are now set for next phase of integration. As Dr. Lal mentioned, that we built a state-of-art reference lab in Vidya Vihar in the month of January this year. Second is, as all of you know, that COVID contributed nearly 50% of the total revenue of Suburban in FY22. It is now down to just 6% in FY23. The stage is definitely set for next phase, wherein we plan to bring in now back-end synergies between the parent company LPL as well as Suburban Diagnostics and go further aggressive in Mumbai and Western region. In the end, I would say the brands that have the trust of the patients and medical fraternity, holistically invested in network creation, infrastructure scale-up, patient services, etc., will sustain and grow in the long run. With that, now I would like to invite our CEO Bharat to continue this conversation. Thank you, and over to you.
Thank you, Om. A very good evening to everyone present here, and I warmly welcome you all to our Q4 FY23 earnings conference call. I will now take you through some of the operating and business highlights of our company. In Q4 FY23, we registered 6.3 million patient visits, generating a total revenue of rupees 491 crores. COVID and allied tests declined 83% and contributed to only 11 crores, that is just 2% of the overall revenue. During the full financial year, we registered 26.9 patient visits and generated a total revenue of 2,017 crores. You would remember last year in Q4, we had a pronounced Omicron wave of COVID with high testing volumes comparable to the end of Delta wave. As a result, test mix profile shifted significantly. Hence, for analysis purposes, one must look beyond YOY growth and use other metrics like sequential and 3-year CAGR numbers. Our non-COVID revenue at rupees 480 crores registered a YOY growth of 14.4% and followed historical sequential trends between Q3 and Q4. The test per patients also moved up from 2.48 in Q4 FY22 to 2.76 in Q4 FY23, representing 11.2% growth in non-COVID tests conducted. Underlying non-COVID patient visits in the organic business grew near 8%. As you are aware, we had taken some price corrections in the month of February 23. The same has got settled and has been absorbed by various segments of our customers. According to our estimates, this price correction has had a 1.7% impact in this quarter and 2.5% on an ongoing basis. We have been focused on 4 strategic programs, building a bundle test portfolio, SwasthFit, super specialty business, enhancing digital capabilities, and geographic expansion, including serving Tier 3 and 4 cities. Like Om mentioned, our bundle test portfolio SwasthFit continues to do very well, and it contributed nearly 22% of Q4 23 of non-COVID business. Overall, SwasthFit portfolio generated a revenue of rupees 370 crores in FY23. Our super specialty portfolio, led by genomic testing division GeneEvolve, Center of Excellence for Reproductive Diagnostics LCOR, and Center for Autoimmunity Excellence LACE, is becoming similar to the SwasthFit portfolio in size and growth rates. Our expansion program aimed at reaching the interiors of the country in Tier 3 plus towns or Bharat continues unabated. We now have 277 labs at the year end, including 70 labs at Tier 3 towns like Siwan, Murshidabad in east, and Sultanpur in the north. We continue to invest in scalable and profitable digital programs, combining medical excellence and leveraging digital and analytical capabilities to improve patient journey. I would like to talk about 3 digital properties recently launched and scaled up today, namely CHIPS, Recommendation Engine, and Patient Wallet. Our CHIPS, Customer Health Improvement Plans, is designed to engage our patients digitally with personalized digital interventions, digital diagnostic interventions. Further, we have built a recommendation engine that shares the specific tests at the point of sales. All these programs combined with a patient wallet will provide personalized, scalable digital customer relationship management programs. We are receiving good customer traction on this program since their launch. We believe we have the right set of building blocks which we have put in place in the marketplace, with a few more in the pipeline, and these we believe will help us deliver industry-leading growth rates. With that, I would like to invite Ved to take you all through the financial performance. Over to you, Ved.
Thank you, Bharat. Good evening, everyone, and thank you for joining this call. I am now sharing some of the key financial highlights for Q4 and FY23. Our non-COVID revenue for Q4 FY23 came in at rupees 480 crore versus rupees 420 crore last year, same quarter, a growth of 14.4%. Whereas FY23 non-COVID revenue came in at rupees 1954 crore versus rupees 1691 crore last year, a growth of 15.5%. Total revenue for Q4 FY23 came in at rupees 491 crore against rupees 486 crore last year, same quarter, a growth of 1.1%. Total revenue for FY23 came in at rupees 2017 crore versus rupees 2087 crore in FY22. Revenue realization per patient for Q4 FY23 is rupees 774 against rupees 728 last year, same quarter, an increase of 6%, led by price increase, test mix, and higher contribution of SwasthFit. Normalized EBITDA after eliminating the impact of RSU, CSR, and one exceptional expenses for Q4 FY23 came in at rupees 131 crore and rupees 528 crore for FY23. Normalized EBITDA margin for Q4 is at 26.6% and 26.2% for FY23. Normalized PBT after eliminating the impact of notional depreciation on account of consolidation of Suburban Financials for Q4 FY23 came in at rupees 102 crore versus rupees 94 crore in last year same quarter, and rupees 400 crore for FY23 versus rupees 494 crore in FY22. Normalized PBT margin is 20.8% for Q4 FY23 and 19.8% for FY22. FY23. Normalized PAT for Q4 FY23 came in at rupees 76 crore versus rupees 73 crore in Q4 FY22 and rupees 297 crore for FY23 versus rupees 369 crore in FY22. Normalized PAT margin is at 15.5% for Q4 and 14.7% for FY23. Cash and cash equivalent as on March 23 is rupees 838 crore. Net of borrowing, it is rupees 601 crore. I am pleased to share that our efforts toward optimizing cost and increasing the operational efficiency by using the technology and digital tools has resulted in reducing our debtor outstanding and inventory to 28 days now. So one side we are doing efforts on front end, patient side, as Bharat mentioned that digital or technology has given the edge. Another side, on the operational side, we are taking technology and tools to optimize the cost. Finally, we are pleased to share that the Board of Directors has proposed a final dividend of rupees 6 per share. With this, the total dividend for FY23 is rupees 12 per share. Final dividend will be paid after the shareholders' approval in the upcoming AGM. This brings me to the conclusion of my opening remarks, and now I would request the moderator to open the forum for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi, good evening. Thank you for the opportunity. Two questions. Firstly, I noticed revenue mix, largely shifting to outside Delhi NCR. So obviously other geographies are doing better. B2B is a bit higher YOY and Swasthfit is obviously growing faster. All of this combined, Om, the question is for you that does this result in margin dilution for fiscal 24 YOY? That's my first question.
Margin dilution for FY24, you said?
Yeah.
We don't think so. Our margins, if you look at, are nearing now pre-COVID levels. So the COVID impact is out. So even in FY24 also, we believe that we should be able to sustain a similar level of margin.
In spite of these three things gaining revenue share, Delhi, outside Delhi NCR, B2B and Swasthfit?
Yeah, you see, outside Delhi NCR, one must realize that as the scale picks up, there are markets which actually mimic like Delhi NCR. And if you notice in the last sort of 4 to 5 years, our expansion through lab network is actually not that fast as it used to be earlier. So because most of it is now building through hub labs, where our tendency is now to open more connection points and labs. So I think we are actually optimizing the lab costs in such a way that our margins don't get diluted. So that's the way we see it. And in any case, if you look at earlier portfolio mix, we always had some markets which are operating on a lower margin, but our rest of North now is fairly scaled up, where margins are pretty healthy there.
Perfect, got it. And secondly, again...
variation is not material enough, so that's the way I would look at it.
Got it. And secondly, on the growth side of it, obviously the starting first quarter of fiscal 24, the base is supportive because we no more have very large COVID revenues. Life coming back to normal, obviously that helps in getting normal diseases, and hence normal testing for non-COVID should pick up. Employee attrition is generally low now in favor of digital labs, is what I understand from my channel checks. And obviously growth outside Delhi NCR is faster than Delhi NCR. So combined of all of this, do you see 13-14% revenue growth next year?
So I think instead of me putting a number, clearly I do believe that we entered in FY23 on a much more difficult outside environment than FY24. As you outlined it very well, pressure on attrition is very low. Our ability to take price increase there, we have demonstrated that. COVID pressure of should we roll back capacity or not, should we buy some more stock, etc. I think now that is also behind us. So the good news is that we are now entering into FY24 with cleaner slate, with less sort of headwinds compared to what we saw last year. I think overall it augurs well. Now coming to growth rate, it's very difficult to put a number right now, but I definitely do believe that we should do better than what we've done previous year.
Got it, perfect. And lastly, just a bookkeeping, the 26.6 million patients non-COVID for full year, could you break down that into Dr. Lal and Suburban separately, please?
For FY23?
Yeah, 26.6 million patients.
We have that number separately.
So Rahul, because we have not, this Suburban was not fully baked in this year, so probably these numbers may not give the right picture. So at this point, I think this is the consolidated number we have.
See, for us, if you look at Suburban, so far our tendency was to show separately because in some quarters we didn't have a base. So now, since that sort of a issue is no more with us, we want to operationally see it as if like both parent and Suburban, they go hand in hand together. So we would want to actually report, not highlight Suburban separately. That's the way we look at it.
Can I get it for fourth quarter in that case? That's a YOY comparison, right?
So I'll come back to you.
That number I think is immediately not available with us. We'll come back to you.
Okay, perfect. I'll come back in the queue. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Prakash Kapadia from Anivet Portfolio Managers. Please go ahead.
Yeah. Thanks for the opportunity. A couple of questions from my end. There have been price hikes in the industry by new age players. Any change in competitive landscape we are witnessing? And, given that growth rates in industry have generally come down post-COVID, so any acceleration or any trends, we are witnessing or sensing shift from unorganized or, shift from regional players for national players like us? That is the first question. We've also, taken some price hikes in our portfolio. So if you could help us understand the impact of revenues for FY24, and is it, in specialty, is it in packages, is it in specific geographies, if you could highlight that. And the third question is, in an endeavor to drive organic growth, what should, be the key drivers for that in FY24 and beyond? So obviously Suburban scale is one of the factor, but how is non-metro contribution shaping up? How is new patient addition happening? New test menu? So some of these points will be helpful if you can clarify.
Hi Prakash, this is Bharat here.
Hi Bharat.
Let me start with the first question on, how the competition intensity is shaping up in the industry, right?
Yeah.
So there are 2-3 ways to look at it. One is that, the incumbent players and let's say some of the newer traditional players, model players, let us say for sake of any other better word, continue to intensely be competitive in the marketplace. So there is no letdown on that count. So including new entrants, regional lab chains, etc., all continue to compete very aggressively in the marketplace like in the past.
Right.
What we are seeing is that some of this new age e-com based Google advertising, Facebook advertising-based companies, because of maybe funding pressure or because they're not able to see the traction themselves, are scaling down, let us say, deep discounting, because patients are also now realizing that the deep discounting are actually a clickbait operation. Whereas when they finally end up paying the money, they pay similar money to what they pay to one of the incumbent players.
Right.
So I think it is all catching up, and industry is in a bit of a transitionary phase. Everyone is trying to innovate and try and do the best they can. So that is the way to look at the competitive landscape today. But yes, the advertising intensity has mildly come down, at least from a ATL, above the line perspective.
Okay.
Digital media competition still continues very intensely.
Okay.
Right?
So this would take time. So Bharat, effectively you're saying this would take time and there is no major shift. It's maybe the pace has decreased, but it remains as competitive as it was.
Yeah. So it is what I said, the world has come to a new age, new world wherein, it's all less competition and everything's back. It is still intensely competitive, all of us fighting for a share of the business. But yes, some segments of competition have kind of come down.
Okay.
Right. So the second question revolved around, just remind me on...
it was about price hikes which we've taken. So is it, for specialty portfolio, is it specific geographies and, the impact of that, if any, on next year and going forward?
So we have not taken any price increase on routine tests, the most commonly ordered tests, including packages. So that is the first statement I'd like to make. We have taken price increase on, what is really esoteric tests, high-end tests, done in reference lab only, and so on and so forth. And I talked about that in the, what I would call the opening speech, of 1.7% impact for this quarter and 2.5% estimated going forward, assuming the mix holds up.
Okay.
Right?
Understood.
So it is not geography specific, it's pan-India basis, and really tests which are less frequently ordered, so consumers and patients don't feel the pinch of that. The good news is that all our B2B partners, from where the samples predominantly come from, have largely accepted the price increase. We are not finding any major impact or pushback as a result of this, because it's been long overdue. They also realize that they have also taken up prices. So I think it has gone well in the execution was planned for.
Sure, that's it.
And on the third question of growth levers going forward, Dr. Lal covered this, Dr. Om covered this, I also covered this. There are 3 or 4 ways to look at it. One is geographic expansion in tier 3, tier 4 cities, along with strengthening our metro city presence, either in wherever we operate in northeast or also including Mumbai. So there is a geographic expansion plan. Second is differentiated channel management programs. We talked about that, I think, in the last quarters also, on how do we manage B2B separately than B2C. So going on channel management programs and driving growth through channel partners. Obviously, we spoke about today high-end testing, either the genomic testing or the centers of excellence on reproductive diagnostics or autoimmunity. Those are all key ways to differentiate your business while delivering value to all stakeholders.
Right.
The fourth is obviously getting the tech stack up to shape so that we constantly provide a wow factor to the patients. Something new has happened. So we spoke about the CHIPS program today. We spoke about the recommendation engine and also the wallet.
Right.
So it's a combination of what we have done traditionally, which is geographic expansion, combining with obviously phosphate and super specialty portfolio, and layering a tech component to that.
Right. Fine. That's helpful. I have 1 or 2 more questions. Maybe I'll join back the queue. Thanks.
Thank you, Prakash.
Thank you. Before we move to the next question, I'd like to remind the participant to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. Thank you. The next question is from the line of Bino Pathiparampil from Elara Capital. Please go ahead.
Hi, good afternoon. Just a quick clarification. When you say the price increases you took will have an impact of 2.5%, is that on your overall revenue or on just the portfolio on which you have taken price increases?
On the overall revenue.
Okay. And what are your plans for addition of labs FY24 and 25?
So our lab expansion program continues the way it's always been, about 10 to 15 labs, predominantly in Tier 3, Tier 4 cities, spread across Northeast and some portions of South and West.
Understood. Great. Thank you.
Thank you.
Thank you. The next question is from the line of Lavanya from UBS. Please go ahead.
Hi, sir. Thanks for the opportunity. So I just wanted to understand the margins for Suburban in this quarter, just because last quarter we have seen a meaningful hit.
So normalized EBITDA margins for Suburban for this quarter is about 11.2%, and for full year it is 12%.
Okay, so we are still seeing the impact of the new franchise opens on the margin from Suburban.
So, no, I think on Suburban, if you go back pre-COVID times, that was the trajectory of the business in any case. I think during COVID times, they experienced very high leverage because Suburban has experienced very sharp drop of COVID revenue this year. From nearly 113 crore, it has fallen to just 9 crore. The P&L shape is very similar to, let's say, what it used to be pre-COVID times. But the important thing is that this has a nearly platform of nearly 155 crore of revenue. 80% of that comes from city of Mumbai. And now, with the sort of support of centralized lab and LPL parent support, we are basically hoping to drive this both revenue synergies as well as the cost side synergies. We realize higher margins, but this is the margin which it used to have pre-COVID times.
And these margins, please note that we have launched this reference lab, big reference lab in Mumbai. So this quarter, all the impact of that reference lab has also counted.
Okay. Got it. So one more thing on the exceptional expense that you have seen in the current quarter. What was it related to? And I just wanted to understand the tax rate guidance that you give for next financial year, FY24.
So this exceptional item is one large amount is receivable from BMC, Bombay Municipal Corporation. As per policy, we have provided, but we are hopeful that this money will come to us very soon. And second, a small amount which has been provided on account of COVID inventory, which is going to expire. So these are the exception items.
Okay. On the tax rate?
Tax rate, we have normal tax rate, which is about 25% for the corporate. There is nothing which is, exceptional here. Normal tax rate.
Got it. Thank you. All the best. Thanks for the opportunity.
Thank you.
Thank you. The next question is on the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi, good evening. First question is on just trying to understand the price increase. You mentioned it is for specialized tests. How has been the experience versus the competition? Has the competition followed you, or have you lost some business because of price hike, or it is status quo and it is value accretive?
So, hi, Bharat here. Two, three things. One is that this price increase has gone relatively well. We were skeptical in the beginning, but I think execution was near perfect in communicating to customers on why this price increase, and in the context of the overall tenure of the price increase, this seemed to be logical and reasonable to them. Number two, we explained the impact. That's about 2.5% on an ongoing basis on the overall portfolio, given the mix of the portfolio on which this price increase has been taken. Yes, now, and we also have not taken price increase on the routine portfolio, the most commonly ordered test portfolio, or the health packages and so on, or the bundled test packages. Now, will competition follow? Each company will follow its own, what I would call, policies, procedures, priorities, etc. But given the inflationary situation, the lowering of COVID volumes, I do expect that everyone will take price increase as per their, what do you call, areas of strength and what they think they should be doing. So yes, in industry price tables should start to move up.
Okay, and the price increase would be only for your specialized, which is about 30-35% or lower in terms of total volume value?
So it's on value basis. It is about nearly 50% of the portfolio is on which we have taken.
Okay, and 50% you claim is your specialized testing menu?
It is not only specialized plus, I said, less frequently ordered tests and so on.
Okay, fair enough. Okay, and the second question was trying to understand the competitive environment in the B2B segment. You know, we hear that, the lot of new players are getting very aggressive, especially on the B2B side. And your progress on the south, please. Thank you.
Yeah. So on the B2B side, my response is that yes, it is as competitive as ever. We have actually put in place multiple programs to better manage this channel and segment this channel like we do for patients. So we have a B2B channel program which is very intense and very well appreciated. And in fact, B2B is one of our fast-growing channels today as well, compared to historical averages. So we are very pleased with the progress, this whole approach of a channel management program on the overall revenue growth rates. On South also, our progress is, continues. We grew South at a reasonable pace compared to what I would call it the company growth rate. We grew ahead of the company growth rate significantly. So I think, yes, we'll continue to build deeper penetration in South and the geographies that we currently operate in.
So B2B, you would have grown, is what you're saying? You've done well, and so
well, good growth rates on B2B.
And margin accretion or flattish?
Yeah. So if you manage the mix well and the cost structure well, and there is also scope to negotiate the back-end cost, so I think it plays out well enough. Also, as the volume grows, testing efficiencies come in, we are able to amortize a lot of control, calibration cost, etc.
Okay, fair enough. Okay, I have more questions. I'll join back with you. Thank you.
Thank you.
Thank you. The next question is from the line of Anish Deora from Nomura. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, I'm looking at the quarter-on-quarter sequential data of 4Q over 3Q. So while the realization per patient has improved and even the number of tests per patient and the number of samples processed have shown an uptake, but if you see the number of patients, that is the patient volume, they have shown a decline over 3Q, which was supposed to be a seasonally weaker quarter over a strong 4Q. So can you share your thoughts around this decline, and is it, pointing out to any particular trend that you are seeing that may have a bearing on the coming periods?
So on patient visits, I don't think we should get swung by quarter-on-quarter movements. There's a lot of base issue last quarter, this quarter, last year, this year, etc. Like I mentioned in the opening comments, our underlying patient visit growth rate is near 8%. Visits. Number of tests performed is at 11.2%, and revenue is obviously higher.
Okay, got it. All right. Thanks. That's it from my side.
Thank you. The next question is on the line of Nitin Agarwal from DAM Capital. Please go ahead.
Sir, thanks for taking my question. Two questions. One is on the operational bit. We've seen some reduction in employee costs on a YOY and a QQ basis. Likewise, if I adjust for the the one-off that we mentioned about 7 odd crores, even other expenses are down. So what would we attribute to these reductions to? Given the fact that business has been growing.
So, while Ved gets into specifics, at an overall level, Ved in his opening comment talked about use of technology in automating a lot of processes, etc. So that has given us a large headcount, what I would call leverage. But specifics around the rest of the equation, Ved, you can take on.
Yeah. So Nitin, so this is primarily because of RSU charge, which is lower than last year, and that is the precise reason for the compensation or employee cost. So this is one. Other expenses, obviously, we had a lot of programs done in this year. Last year, where efficiency has been created. As in my opening remarks, also I've said a lot of use of technology tools we have created, and duplication of the repetition of the work which can be used by technology tools. So those are given some advantage, and that's why we have got some advantage on other expenses.
And secondly, on the now since we have the full year numbers and you have some more clarity on the post-COVID trends, what is a realistic, a ballpark range that one should work with in terms of the patient testing volume growth for us?
Volume means patient, you are saying?
Yeah, patient volume growth, yes. Going forward, on a directional basis, it's a late single digit, early double digit, mid double digit. What is the realistic number, that one, given the industry dynamics, we can work with?
See, it's very difficult to put a figure, but I think the first question which was asked is that we do believe that FY24 numbers should really be better than last year figures. I think all sort of variables are pointing towards that. We will not have that sort of a competitive scenario as we experienced last year. And as you mentioned that since COVID is not there, it's actually in one way good news that we're done with it in 1 year itself. Otherwise, we would have been struggling with this base effect. And now we can completely focus on non-COVID business. I think the only thing we are now carrying with us is, I think, 63 crore of COVID.
63 crore.
60 COVID and allied. COVID and allied business in our base. If we don't know, it's highly unpredictable. It can actually be as good as zero as well. It could be same. But I think if I take this out, we definitely are hopeful of improving our performance in FY24.
And just last bit on that, typically is from a seasonal perspective, isn't Q4 supposedly a better quarter for the diagnostic business than Q3?
No. I mentioned in the opening speech saying that sequentially Q3 and Q4 are similar for us.
I think it's a fair. I think we've also made this comment in the past, but I think for the last 2-3 years I'm seeing that even these variations come due to infections. And for some reason I find that you are not following the pattern because Q3 is no more a heavy season anymore. Even in Q3 also we are having a lot of infections. So in some way Q3 actually has moved up while Q4 may have been similar. So that's why the difference you see is much less than before. Let's see how it happens this year because this COVID thing has always been there, right? In fact, this whole respiratory infection in general has been there in the population. I think let's just wait out for FY24. But you're right, Q3 is generally a softer quarter, but we have not seen that trend the last couple of years.
And since you mentioned that point, infections, we've seen very high intensity of incidence of infections the whole of FY23, which is reflected in, I guess, the pharmaceutical sales of anti-infectives and all the cold and cough preparations. Has it had, in your assessment, any tailwind for our business also?
Actually, respiratory infections in general do not really directly lead to very high jump in testing. In fact, while we were all talking about during this month of April and even in March also we talked about COVID, etc. We didn't see a direct sort of jump in COVID testing. But I think one test which normally tends to go up in situations like this is CRP, which is inflammatory marker. So that is one test we have seen a very significant jump in Q4, right?
Yes.
So CRP is one test we saw a big jump.
And lastly, on the realization per patient, obviously with the bundling that we are doing, that's sort of going up. We are, 780 or thereabouts for this quarter. How does one look at this number? Is there a significant scope for appreciation from these levels on this number?
I don't think so. It has suburban cycles.
Yeah.
I think there are a few things that have gone into this. One is, of course, bundle packages now contribution going up to 22%. I don't foresee a very sharp jump again in the contribution. I think it should stabilize around this number. Suburban in general has a higher realization than Dr. Lal Pathlabs. So that also has gone in for the full year impact. I think whatever little will come now is due to price increase that we've taken in the month of February. Maybe that will have some marginal impact. Mix may not change. My gut says that we may not see a very sharp jump on this in FY24.
Thank you. Best luck.
Thank you. The next question is from the line of Sindhara Karwala from JM Financial Limited. Please go ahead.
Thanks for the opportunity. Am I audible?
Yes, right.
Yeah. So if we are looking at the volume growth, you in your opening remark quite interestingly highlighted the Mumbai lab. We know our earlier labs, whenever they have come, they have given us a good traction. So what do you think about the Mumbai lab, how it will contribute to our overall patient growth? Like, how should we relate this, if you can help us understand this?
Right. Hi, this is Shankar here. So the Mumbai lab has been launched in January, and so the thing is, it's going to be a slightly longer wavelength compared to the other reference labs, because from the suburban point of view, it's kind of starting a completely new vertical, so to say, in terms of the specialized business, and also trying to get a completely new customer client profile to be built under the portfolio that we are currently doing. So from that point of view, yes, from the last few quarters, it will definitely have better impact in terms of patient growth. But it may not be exactly comparable in terms of the things which we saw in East, Calcutta or Bengaluru. It might take a slightly longer wavelength.
Understandable. And in your opening remarks, you also mentioned about a slightly higher cost base that we carried for the entire FY23. So now if we look at our cost base versus the growth that we have seen, at least the normalization that we have seen in FY23, do you think the upcoming year, FY24-25, this cost base will support us on the growth? And we should see some operating leverage also?
Yeah, Cinderella, Ved here. So definitely, see, that's the idea, because one is, launching this reference lab, which will obviously give advantage. And what Shankar is saying on B2B side. But another, because, all the infrastructure is in place, and I think you also have visited that lab. Now we have to leverage this infra. In our view, the efforts is on, more on top line, but similarly, the operating leverage will also come on the bottom line. So I believe that margins from here should improve.
Okay, that is helpful. And so if we try and understand the overall marketing scenario today, you highlighted that there is some sluggishness, there is intensity continues. We have taken specialized price increases, but the specialized price increase should reflect across the entire year, right? I mean, we just started in month of Feb. Is that understanding correct?
Yes, indeed.
Okay. Okay, thank you so much for my questions. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Rishi Modi from Marcellus Investment Managers. Please go ahead.
Yeah, no, my question's been asked earlier. I tried removing myself from the queue, but it didn't.
Thank you. The next question is from the line of Tanmay Gandhi from Investec. Please go ahead.
Yeah, hi sir. Thanks for taking my question. Sir, first question is on the sequential growth, right? If we historically look at our sequential growth in 4Q, it had ranged between 3 to 5%, right? But this time it was flat. So anything worth highlighting here?
We couldn't hear your question properly. Could you repeat yourself if you don't mind?
Your line is not very clear.
Is it better?
Yeah.
So my question is that, historically, if you look at our sequential growth for 4Q, so historically it has ranged between 3 to 5%, right? But this year it is flat. So anything particular you would like to highlight here?
So that's what I actually mentioned. Your observation is right, that it's not 3 to 5%, normally it's about 2%. And the 2% actually is neither here nor there. So sometimes depending on the infection rate, it is flat. But I'm actually seeing this trend for the last 2 years. Even I think if I remember even the previous year also we saw the same thing. So my hypothesis is that now it's just evened out in terms of infection rates. See, earlier Q3 was seen as a healthy quarter. I think now because of air pollution, etc., all these things, generally the Swasthfit, which is more screening packages, it's become a little bit of even. So looks like now the pattern that I'm seeing is that Q2 is the highest. All of the 3 quarters are very similar, Q1, Q3 and Q4. That's the observation that I have for the last couple of years. But let's see in FY24 what happens, because this at least will not have this whole variable of COVID. At least it will be more cleaner space. But your observation is right. This time we are not seeing a sequential jump which we normally see. And this is not the first time I was going. Even last year also I did notice that.
Okay. And sir, we understand that, year-on-year growth for this year is not that relevant because of volatile base. But sir, if we try to extrapolate our sequential growth, which we have seen during the last 4 quarters, right, to FY24, then it roughly translates to, mid to high single-digit growth. So is that the right way to look at it?
No, I don't think. It will be, our estimate is, I know we have done 15.5% non-COVID, but it also has 4 quarters of summer months compared to 2 quarters previous year, right? So the normalized growth will be how much for this year? 11% or so. 10 points. 10 to 11%. Yeah, we definitely have to better this performance this year. It won't be single digit.
Okay. And sir, last question on Swasthfit, right? So we have been saying that, largely it has peaked out, and you don't see any sharp jump from this level, right? And historically, our revenue growth was largely driven by patient and, sample growth. But this year, it was also driven by higher realization per patient. Going forward, as we expect some moderation in Swasthfit expansion, so do you see that again our revenue growth would be driven by volume and volume growth has actually come down, right?
So yes, our efforts will always be to drive the volume growth, patient visit growth, not volume, patient visit growth, and there are various techniques we are using to get better on that count. But as a result of bundling, the test per patient is also moving up significantly, about 11% in Q4. And that trend, depending on how Swasthfit further grows, it will reflect in the numbers. But our intrinsic effort is to acquire new customers and service our existing customers in a better fashion.
Understood. And a related question, in 4Q, did we have any one-off kind of growth in tax-related packages in Swasthfit?
Growth, or what did you say?
Growth in tax-related packages for Swasthfit? Any one-off growth?
Packages.
Yeah.
So last 2-3 years, I think Q4 Swasthfit picks up because of this tax advantage. It's a normal phenomenon. It's in the base as well. But this year's growth has been still better than the previous year, led by better distribution, better understanding from patients, acceptance, etc. So it is more than tax.
Okay, got it, sir. Thank you. That's all from my side.
Thank you. The next question is from the line of Yogesh Tiwari from Arihant Capital Markets. Please go ahead.
Thank you, sir, for taking my question. Am I audible?
Yes.
Yeah. So my first question is, post-COVID, what would be the growth of the in vitro diagnostic industry?
In vitro diagnostics.
Yes, sir.
Normally, IVD industry, we refer to the reagent suppliers. I presume you're asking for pathology, right? People like us, right?
Yeah.
So as I mentioned to you, this data which is available in public domain, I just added up at least 4-5 companies' data. The last 4 years CAGR, I have removed this impact of COVID years, which is FY21 and 22. The growth rate that I'm seeing is about 10 to 11% CAGR over 4-year or 3-year period. I personally feel that it should sustain. One variable which probably is going to get added because last 4 years CAGR may not have very high pricing impact, but since our ability to take price increase is now coming back, let's see how other players do. But my reading is it will definitely be in this range going forward.
And sir, what would be the total size of the industry if you can share your thoughts?
What will be the total size of the industry?
Yes.
So there is no published data that's available. Normally we refer that these large players contribute about 15% of the value. So I think one crude method would be that divide this 5,000 crores by 0.15 would be about 40,000 crores, which is essentially the private lab business. And then you add this to what hospital lab business is there. So my sense is it should go up to 60,000 crores, something like that. That's one of the ways to look at it.
Which you mentioned, this is for the Indian domestic, right?
Yeah, India domestic market.
Okay, so that's very helpful, sir. Thank you very much.
Thank you. The next question is on the line of Praveen Kumar from Equitas Capital Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. I had a couple of questions. The first question was on a comment that Dr. Om had made in his opening remarks. He had mentioned that the bundle packages have become a way of life. So just thinking about the comment a little bit more, in terms of bundle packages, the decision-making point could be perceived to shift to the customer, the patient instead of the doctor. And since the doctor connect is a major competitive advantage for Dr. Lal, how do you perceive this, panning out in terms of your competitive advantage? Yeah, that was my first question.
No, I think that's a great sort of a question. My reading is if it is only limited to preventive health checkup, yes, decision making is with consumer or the patient. Since a lot of chronic disease patients also are shifting to bundle pack, they actually upgrade these packages mainly to see better value for money. So even illness patients are also in bundle packages. So doctor decision making is still there. Only thing is that doctors also have started prescribing now these packages as a part of a normal prescription.
Okay, understood. Thanks for that. I had a second question, which was more on the investor presentation, the financials in particular. What I wanted to understand was, the company declares normalized EBITDA margins, where a few items are excluded. One of which is the employee stock compensation of the RSU-based compensation. So just wanted to understand the rationale for excluding this. Is it that you perceive these to be more one-off kind of expenses? Because if not, if you perceive that these are more ongoing nature of compensation-based practices, then in one way or the other, the company is bearing the cost for that, right? So shouldn't it be part of the overall EBITDA itself, not a specific normalized EBITDA? Yeah,